the garbage company that threw away honest accounting principles. In the summer of 1998, Arthur Andersen auditor Walter Serkovsky sat in a waste management conference room, staring at numbers that didn't add up. The garbage trucks outside rumbled past the Houston headquarters, collecting America's refuse with clockwork precision. But inside these walls, the real trash was buried in spreadsheets and financial statements. Serkovsky had stumbled upon what would become the largest accounting restatement in corporate history up to that point, a staggering $1.7 billion fraud that had been festering for 5 years. The irony was almost poetic. A company built on collecting garbage had been manufacturing financial garbage all along, and now the stench was about to become overwhelming. Dean Buntrock, the silver-haired CEO who had transformed a small Wisconsin waste hauling business into North America's largest garbage company, had presided over a culture where meeting Wall Street's expectations mattered more than following generally accepted accounting principles. This wasn't just creative accounting. It was accounting fraud on an industrial scale, involving the systematic manipulation of depreciation expenses, the improper capitalization of costs, and the deliberate inflation of asset values to create the illusion of steady growth and profitability. The roots of waste management's fraud traced back to the early 1990s, when the company faced increasing pressure from Wall Street analysts and investors who expected consistent earnings growth. Founded in 1968 by Dean Buntrock and his cousins, Waste Management had grown through aggressive acquisitions, purchasing hundreds of smaller waste hauling companies across the United States and Canada. By 1992, the company had become a Wall Street darling, trading on the New York Stock Exchange and boasting a market capitalization of over $9 billion. However, the waste management industry was maturing, and organic growth was becoming increasingly difficult to achieve. Landfills were reaching capacity, environmental regulations were tightening, and competition was intensifying. The company's stock price had become increasingly sensitive to quarterly earnings reports, and missing estimates could trigger massive sell-offs. It was in this environment that senior management, led by CEO Dean Buntrock, Chief Operating Officer Philip Rooney, Executive Vice President James Koenig, and Chief Financial Officer Thomas Howe, began implementing what they euphemistically called aggressive accounting practices. These weren't isolated incidents or honest mistakes. They were deliberate, systematic efforts to manipulate the company's financial statements to meet or exceed analyst expectations quarter after quarter. The primary vehicle for Waste Management's fraud was the manipulation of depreciation expenses related to garbage trucks and containers. In the waste management business, trucks and containers represent the largest category of depreciable assets, and the methods used to calculate depreciation can significantly impact reported earnings. Under generally accepted accounting principles, companies must depreciate assets over their useful lives using reasonable estimates of salvage values and depreciation methods. However, Waste Management began systematically extending the useful lives of its trucks from the industry standard of 8 to 10 years to as much as 12 to 15 years. They also artificially inflated salvage values, the estimated value of assets at the end of their useful lives, from realistic percentages to numbers that bore no relationship to actual market conditions. For example, garbage trucks that might realistically be worth 10% of their original cost after years of heavy use were assigned salvage values of 25 or 30%. These changes had an immediate and dramatic impact on the company's bottom line, reducing annual depreciation expenses by hundreds of millions of dollars and artificially inflating reported profits. The manipulation was so pervasive that by 1997, the cumulative effect of these depreciation games had reduced expenses by approximately $1.1 billion over 5 years. Beyond depreciation manipulation, Waste Management engaged in numerous other fraudulent accounting practices that demonstrated the breadth and sophistication of their scheme. The company improperly capitalized a wide range of operating expenses, treating costs that should have been immediately expensed as capital investments that could be depreciated over several years. Routine maintenance costs, interest expenses, and even some payroll costs were reclassified as capital expenditures, artificially reducing current period expenses while inflating the value of assets on the balance sheet. They also manipulated their environmental reserves, funds set aside to cover the costs of landfill closure and post-closure care as required by environmental regulations. When actual environmental costs came in lower than expected, instead of adjusting future reserve requirements, management would reverse excess reserves into income, creating artificial earnings boosts in quarters when operating performance fell short of expectations. The company engaged in aggressive revenue recognition practices, recording revenue from long-term contracts before the services were actually provided, and manipulating the timing of asset sales to smooth earnings. They also understated various liabilities and accrued expenses, particularly related to vehicle maintenance, landfill operations, and employee compensation. Perhaps most egregiously, they assigned arbitrary and unjustifiable values to assets acquired in business combinations, often allocating excessive values to goodwill and other intangible assets that would not be subject to regular depreciation. The fraud was orchestrated from the highest levels of the company, with CEO Dean Buntrock playing a central role in directing the manipulation of financial results. Buntrock, who had joined his brother-in-law's small waste hauling business in Wisconsin in the 1960s, had built waste management into an industry giant through hundreds of acquisitions and had become accustomed to delivering consistent growth to Wall Street. When organic growth became more challenging in the 1990s, Buntrock and his senior management team made the fateful decision to manufacture growth through accounting manipulation rather than acknowledge the company's changing business realities. Chief Financial Officer Thomas Howe was responsible for implementing many of the specific accounting schemes, working closely with divisional controllers and other finance personnel to ensure that the company's results matched predetermined targets. The fraud required extensive coordination across the organization, with regional managers and divisional controllers receiving explicit instructions about how to manipulate their local financial results to contribute to the overall corporate objectives. Internal auditors who questioned these practices were often reassigned or terminated, and the company's audit committee, dominated by long-serving directors with close ties to management, failed to provide meaningful oversight. The scheme also involved the manipulation of budget processes, where unrealistic assumptions about asset lives and salvage values were embedded in annual plans and then used to justify the accounting treatments. Senior management even went so far as to retroactively adjust prior year depreciation calculations when they needed additional earnings boosts, a practice that violated fundamental accounting principles about the consistency and reliability of financial reporting. Arthur Andersen, Waste Management's longtime auditor, played a troubling role in enabling the fraud through a combination of compromised independence, inadequate professional skepticism, and prioritization of client relationships over audit quality. The relationship between Waste Management and Arthur Andersen stretched back decades, with the accounting firm earning substantial fees not only from audit services but also from consulting, tax preparation, and other non-audit services. Over the years, numerous Arthur Andersen partners and managers had left the firm to take senior positions at Waste Management, creating a revolving door that compromised the auditor's independence and objectivity. By the mid-1990s, Arthur Andersen was earning more than $7.5 million annually from Waste Management, making it one of the firm's most important clients. This financial relationship created powerful incentives for Andersen auditors to acquiesce to management's aggressive accounting positions rather than risk losing the lucrative engagement. Year after year, Andersen auditors identified the company's questionable accounting practices during their audits, preparing detailed schedules that quantified the impact of various manipulations on reported earnings. However, instead of requiring Waste Management to correct these errors, Andersen would negotiate adjustments that allowed the company to correct some problems while continuing others, effectively managing the extent of the fraud rather than stopping it. The firm's audit work papers would later reveal that Andersen knew about the depreciation manipulations, the improper capitalization of expenses, and numerous other problems, but chose to treat them as acceptable differences of opinion rather than violations of generally accepted accounting principles. The waste management fraud began to unravel in 1997 when a new management team, led by CEO Maury Myers, took control of the company and initiated a comprehensive review of the company's accounting practices. Myers, a former Union Pacific executive with no prior ties to Waste Management's existing culture, had been brought in by the board of directors to revitalize the company's operations and restore credibility with investors. Unlike his predecessors, Myers insisted on rigorous adherence to accounting standards and began asking uncomfortable questions about the company's financial reporting practices. The new management team, working with fresh eyes and no investment in defending past decisions, quickly identified numerous areas where the company's accounting treatments appeared questionable or unsupportable. They engaged forensic accountants and launched internal investigations that revealed the systematic nature of the manipulations that had been occurring for years. The investigation process was painstaking, requiring the review of thousands of transactions, hundreds of acquisitions, and complex depreciation calculations across dozens of operating divisions. As the scope of the problems became clear, it became obvious that the company would need to restate its financial statements for multiple years, a process that would require extensive coordination with auditors, regulators, and legal counsel. The restatement process revealed that Waste Management had overstated its pre-tax earnings by approximately $1.43 billion over 5 years from 1992 to 1997, with the largest single component being the $1.1 billion in understated depreciation expenses. When Waste Management announced its massive restatement in July 1998, the revelation sent shockwaves through the financial markets and regulatory community. The $1.43 billion in overstated pre-tax earnings represented the largest accounting restatement in corporate history up to that point, dwarfing previous scandals and demonstrating the potential magnitude of accounting fraud in major public companies. The company's stock price, which had traded as high as $60 per share in 1996, collapsed to under $30 following the restatement announcement, wiping out billions of dollars in shareholder value. Institutional investors who had relied on the company's apparently consistent earnings growth found themselves holding stock in a company whose historical financial performance had been largely fictional. The restatement revealed that in some years, more than half of the company's reported earnings growth had been the result of accounting manipulations rather than operational improvements. Beyond the financial impact, the Waste Management scandal raised serious questions about the effectiveness of the corporate audit process and the independence of major accounting firms. The fact that Arthur Andersen had signed off on fraudulent financial statements for 5 consecutive years, despite having detailed knowledge of the company's questionable practices, highlighted fundamental problems with the audit profession's self-regulatory approach. The scandal also demonstrated how board governance failures could enable management fraud, as Waste Management's audit committee had failed to provide meaningful oversight despite clear warning signs about the company's aggressive accounting practices. The Securities and Exchange Commission's investigation into Waste Management resulted in unprecedented enforcement actions that would reshape corporate accountability standards for years to come. In March 1999, the SEC filed civil fraud charges against 6 former Waste Management executives, including Dean Buntrock, Philip Rooney, James Koenig, Thomas Howe, Herbert Getz, and Bruce Tobekson, alleging that they had orchestrated a massive scheme to inflate earnings and deceive investors. The SEC's complaint detailed how these executives had deliberately manipulated accounting records, provided false information to auditors, and made misleading statements to investors and analysts. Dean Buntrock, as the scheme's primary architect, agreed to pay $30 million in penalties and disgorgement, while the other defendants paid amounts ranging from $100,000 to $3 million each. All 6 executives were permanently barred from serving as officers or directors of public companies, effectively ending their corporate careers. The SEC also took the unprecedented step of charging Arthur Andersen with audit failures related to the Waste Management engagement. In June 2001, Andersen agreed to pay $7 million in civil penalties and accept a cease and desist order that required the firm to implement extensive reforms to its audit practices. The settlement marked the first time the SEC had successfully prosecuted a major accounting firm for audit failures, setting an important precedent for future enforcement actions. 4 individual Arthur Andersen partners were also sanctioned, with audit partner Robert Allgaier agreeing to pay a $50,000 fine and accepting a 1-year suspension from auditing public companies. The waste management scandal's impact extended far beyond the immediate financial and legal consequences, serving as a catalyst for broader reforms in corporate governance, auditing standards, and financial reporting requirements. The case demonstrated how a combination of management fraud, audit failures, and board oversight breakdowns could result in massive investor losses and market disruption. It highlighted the conflicts of interest that arose when audit firms provided extensive consulting services to their audit clients, leading to calls for greater auditor independence. The scandal also revealed how stock-based compensation could create perverse incentives for executives to manipulate financial results, as Waste Management's senior managers had received millions of dollars in bonuses and stock option gains based on the fraudulent financial performance. In response to these concerns, the SEC began developing new rules requiring enhanced disclosure of executive compensation and greater board independence. The case also influenced the development of new auditing standards that required greater professional skepticism and more rigorous testing of management estimates and assumptions. Perhaps most significantly, the waste management scandal helped build momentum for the comprehensive corporate governance reforms that would eventually be enacted through the Sarbanes-Oxley Act of 2002. The case study became required reading in business schools and professional development programs, serving as a powerful example of how ethical failures at the top of an organization could cascade throughout the entire enterprise. For waste management itself, the scandal marked the end of an era and the beginning of a lengthy rebuilding process that would take years to complete. The company eventually recovered under new leadership, implementing robust internal controls and governance practices that helped restore investor confidence. But the damage to its reputation and the broader lessons about corporate accountability would endure for decades to come.